Good day to everyone. Hope you're doing well. I don't know if my voice is coming out clearly, so you can just write in the comment section if you can hear me. Just comment down below and let me know if you can hear me. All right. So you can just let me know if you can hear me. If there's a place where you can comment, just write in the comment. So I have a few ideas of things that I want to talk about today, and I will I'll go forward with it. Okay. Welcome to everyone that just joined the live. If you can hear me clearly, if my mic is clear, because I'm using a different mic, so you can just let me know if you don't hear me clearly, so I can use the big mic. The big mic takes up the space, and I don't like it when the space is taken up. You know, so you can just let me know. Yeah. So obviously, we're working on creating the best content ever, and some things take time. Okay, some things take time. Let me hear if my audio is. I want to make sure if my audio is clear. Yeah. So. Oh, my audio is amazing. No. My audio is amazing. All right. My audio is amazing. I'm live and my audio is amazing. All right. So since my audio is amazing, let's move to the next thing. All right. I'm not going to be here for a long time. But I have planned out what I want to talk to you guys about, and the live session is going to. I want to make sure that every live session we have some few things we're talking about, and also we go through the chart. All right, that's the aim of the live sessions. Not only for us to, you know, go straight to the market and then like there's no foundation or there's nothing that important that we've spoken about. So like one of the mistakes that many people do is that they don't read the market before thinking about the trades. All right. So you would run into the market and say that it's a buy and then you buy, or it's a sell and then you sell, but you don't really understand why you are buying or why you are selling. You do not go in depth in the market, and then you don't trade. And only after executing the trades, then you are now starting to see two different type of analysis. One side is buying, one side is selling, and that gives you now a sense of panic. And also, when you are trading, most of the traders lose because they start with entries instead of context. All right. So if you don't have context, if there is no context behind your trading, then at the end of the day, obviously, it's going to end up in a loss. All right. That's a event. It's an obvious fact. It's a obvious fact that you're going to lose if there is no context behind your trading. So it's very important that when you're trading the market, that you have a context. You first analyze the market. You know it's an uptrend, or it's a downtrend, and now you know, okay, the market is an uptrend, but still, I think that it has just made a big move now. Let me wait for the market to retrace so that I can, enter into the original move, to avoid drawdown and all that stuff. So top-down analysis from higher time frame to lower time frame. So many people also don't understand how to analyze the market from the higher time frame to the lower time frame. They cannot predict the market from higher time frame and lower time frame. So they will just be on one time frame, and then that time frame will now determine where their direction is. So the person will just come and say, okay, it's a buy, and out of the blue you buy because you see the 50-minute is buying, but your 50-minute can buy and then your 4-hour can sell, and then obviously your trade gets eliminated, and that causes you a lot of emotional pain because you do not want to wait for the right time to execute on the trade, right? So there is a difference between movement and direction in the market. Okay, there's a difference between the movement of the market and there's the direction of the market. Direction is where the market is going. The movement is basically what the market is doing now. All right, so don't get it twisted, get those facts right. There's a difference between that. So the first thing that you need to understand is market structure. All right, the highs and the lows, when they matter the most and when they don't. Okay, ranges and trends. All right, and where structure breaks, meaning sometimes it's just noise. Like there are times that the market is not really breaking structure, it's just taking liquidity, and that can be noise that the market uses against you. And those are all the things that we are going to go through, all right, in this video. So basically the reality is that structure tells you who is in control. Okay, structure tells you if there are buyers in control or the sellers in control of the market. All right, so you have to filter out two things only. There are only two things you need to filter out, and that is it an impulsive market or is it a corrective market? Impulsive means, is it buying or is it correcting, is it retracing? It also comes with, is it selling or is it retracing? So you can know the structure of knowing that, oh, this market is buying, is a bullish market, is creating highs and lows. Okay, you have determined that, and you know that the market is creating highs and lows. Okay, but there are times that you will, not know that the market is in a retracing mode. It can be in a bullish movement, but it can retrace. So what I mean by that is, if we go straight to our charts, all right, if I show you my charts over here and you look at the bigger picture right here, all right, let me open an instrument that makes more sense, like this gold move. I've been trading gold now, and that's why I want to talk about gold. All right, so gold shows us in history now. Gold is not really an exemplary pair that one can use if you want to build understanding on the market. So let me go to Euro USD. Gold is more advanced. We can talk about gold on another day. All right, so now the higher time frame right here on this analysis, all right, or on this market, it shows us that the higher time frame is selling, right? All right, it's in a downward movement. But now the question would be, now since the market is already in a downward movement, okay, is it in an impulsive phase or is it in a retracing phase? And that's where many people get it wrong, because you see, you might see the market is in a downtrend 100%, right? And then you make your sell position right there. All right, you put your sell position there and then you put your stop loss there. All right, so the market has already developed, played out, and then you ended right here because you believe the market is going to sell. But remember, now there is a break of structure and that is taking place right here. Break of structure has played out, and now the market obviously has to make a retracement to make the next impulsive move. So your direction is right, but you did not make sure that you understood the market's movement. All right, you did not understand the market's movement. So it's very important that you differentiate between direction and movement, because your direction analysis can be right, and then your movement of understand what the movement of the market is going to mess up your whole analysis and going to mess up your whole psychology, and then you might want to change strategies most of the time while it's not even so. All right, that's why it's very important that you understand these things. So the direction was in actual fact a sell. All right, it was a downward movement, but It has a downward direction. But the problem comes now where you failed to understand that price has already broken structure. So the fact that price has broken structure and you did not identify that the price already at the end, you ended at the end expecting the market just to continue falling, as if the market does not have two phases. You forgot that the market has the impulsive phase and the corrective phase, and that's where we mostly mess up. Now imagine this type of a setup is not even a B setup, it's not even an A setup, it's a C setup, because you ended the trade while it's already close to the break of structure. And these concepts that I'm talking to you about are actually the concepts that help you identify when the market is actually, and also where the market is going, and actually knowing how to grade your setups. You know, if you know how to grade your setups, you're actually going to be more profitable in the market. Other people will get mad and say, oh, no, why is he teaching this type of stuff in like on a public platform? It's because I don't want to gatekeep. I want to give you information that you can use. You know, I want to be impactful. All right, my aim is to be impactful to you in the market. So first thing first, all right, make sure that you join the Telegram channel of Sophia FX. If you did not see the Telegram channel, this is a free Telegram channel that we have. Make sure that you join our Telegram, our public Telegram channel. I'm going to drop it in the description, so you'll be able to get access to the Telegram channel. Just give me one moment, and then you'll be seeing that information being given to you. So, and also share the broadcast, guys. Share. Let me just add Telegram over here. All right. So you can just copy that link below, and then you can basically, you will be able to join the Telegram channel. All right. So I know in a short period of time I dropped a lot of stuff, and now all of you are like wondering, whoa, this is too much. No, I wanted to establish an understanding for you. Yeah, I can see that the chat is also open now. My aim was to establish an understanding for you in the market, so that you understand what you are doing when you're trading, because the one time frame does not work alone. One time frame does not work alone. You cannot just depend on one time frame to analyze the market. You cannot just say that this is one, like what the market is going to do based on the movement, and the movement is mainly found in the lower time frame. The lower time frame is where movement is. Higher time frame is where direction is. Direction is on the higher time frame, and I want to embed this inside of you, so that you understand it fully. All right. The next thing that I'm going to talk about, before I show you my thoughts on what the market is doing long term and all that stuff, is patience. All right. I want to talk about patience, and to make you understand that you don't need to trade every day. You don't need to be in the market every single day. And I'm always preaching this. I'm always on repeat. I sound like a broken record because of this. Many people don't agree with me. They think that, but it's obviously a amateur mindset. You know, amateurs think that you need to trade every single day, because they believe that for you to be a trader that makes lots of money, from Monday to Friday, you need to be executing trades. If you're someone that is having that desire of always trading, then you should grade your setups. Grade your setups so that the losing setups don't affect your days. I had a losing week, basically, where I lost money, obviously, and that did not shape me. All right, that did not shape me. Like, I have got weeks where I'm not profitable the way I'm supposed to be, but that does not shape me as a trader. I take the hit and then I move on. And the reason why most of the time I will have negative weeks and not blowing weeks is because I came to the understanding that I don't need to think that every day is a winning day or every day is a trading day. So I graded my setups in A setups, B setups, and C setups. So at the back of my mind, I know that an A setup is the highest probability setup that I have. The highest probability setup that would make sense for me, all right, in the long run. I know that this is the higher yielding setup that's going to bring me more capital. So on my A setup, I don't really risk, a lot of percent. I make sure that I risk maybe 1% or 2%. It depends also on the account type. If I'm trading this account to flip it, then obviously I will risk a lot of percent. But when I'm growing, large capital or prop firms or all that stuff, I make sure that I'm risking minimal. All right, the highest risk that I can approve someone that is trading a prop firm account is 1%. Because even if you're trading a prop firm account of 200K, if you are risking half of 1%, you are basically making, a lot of money. All right, that's 1,000. Like, you are risking half of 1%, which is 1,000. If you make 5% in a week, you already made 5,000. All right, that's enough. Rent is 1,000 US dollars usually, so like in a week's time you can make up your rent. You can make up money for basic stuff without even risking. So which means even if you have a losing week, right, you would lose basically if you're trading A setups, and you have a losing week, which means 5 days you've been losing consistently, which is impossible if you are looking for the right setups. It's very impossible for you to be losing 5 days following each other. Then I don't even think you should be trading a live account. I don't even think you should be engaged into looking at large capital. You should be engaged into looking for demo accounts, and you should be engaged into learning and improving your skill. You should be in a mentorship or something like that. Because I would not agree that if you're losing Monday, Tuesday, Wednesday, Thursday, Friday, at least break even, yeah, makes sense. But all of those days, if you're losing, then there's something wrong with your skills. You need to go and enhance your skills and improve your skills, and only move to a live account when you see that you are ready, and not move to the live account with lots of capital. No, you need to take baby steps to bring back your confidence, by the way. So so I would not agree with telling someone that they should immediately move to a live account. All right, so when I talk about patience, trading does not mean you are profitable. You can trade every day and lose, but not trading can make you more profitable. I know this sounds controversial, but not trading can make you more profitable. Not trading or avoiding to trade can make you a more profitable trader than the trader that trades every day. So if you have 3 profitable trades per week or 2 profitable trades per week, you are more profitable than a trader that trades every day or trades 5 trades a day. There are people that trade 5 trades a day. They'll be trading every single day, and every session 5 trades, next session 5 trades. And I don't agree with that. I don't agree with people that are trading every single day. All right, So the cost of forcing trades is going to be extreme on you, and it's better to wait for price to come to your level, to your zones, to your areas of confluence, so that you can be able to trade the market. All right. So professionals are more comfortable, with not trading. They are fine with not trading even for 2 weeks. They are fine with taking losses because they know the probabilities of the long term. Professionals are people that even if they lose in the market, they know that there is still 20 days in the market, so 5 days of losing is not that bad. The next 15 days can be more better than the 5 days that have been losing. So, or even if they don't trade high quality setups and they trade C setups and B setups with low risk, so instead of you risking 1,000, which is 0.50%, you risk 200 or 500 because you're waiting for A setups to form. That is a more professional way of approaching the market and looking at the market. So if the market is not clear, your job is to wait. All right. If the market is not clear, your job is to wait, not to gamble. And I know it's very difficult for you to sit on your hands. Many of you are actually struggling with that. Many of you are struggling with the fact that you are not trading. So you want to trade. You so badly want to trade. You so badly want to be, you like the feeling of seeing profit and loss. But you're actually making yourself more poor. You're making yourself more poor when you are not disciplined. You're making yourself more poor if you are not engaged in the market. All right. The next thing that I want to talk about is risk management. All right. Risk per trade. All right. It's very important that you know how much money you are risking per trade and all of that stuff. So we are going to go into the market now, and we are going to look at a few things, and I'm going to explain as I'm going, and the video will not be too long. It's just to give you an understanding of what the week is holding for next week, basically. And like and share and subscribe to the channel as usual. So let's look at the market. The first instrument that we are going to look at now is DXY. All right, we are going to move to DXY and look at DXY. So DXY has already played out the analysis of what we've been looking for. So this is the low, and price came eventually to this area. Now obviously we know that we are going to see this highs being taken out. That is a basic understanding of what DXY will do, all right, to take out these highs right here. So if you're on the 15-minute, basically just look for price to keep the market structure. You see, so eventually this was the high that I marked and the low. So basically break of structure, price came back, and then at the demand zone, beautiful setup, and then spiked all the way up. All right, that was a beautiful setup, and price played it out. So now usually this type of setups where this high is being taken out, most of the time, okay, sometimes, but most of the time, those type of setups play out during the Asian session. And I know it's very painful because like you will be sleeping, and then if you are in Central Africa, you'll be sleeping, and then the market will move. But for the people that are in the US, it's a different story. The time that they are sleeping, it's actually London session. So we have a better time zone, meaning that our time is nicely distributed. That London session is our morning. From 1 p.m. it's New York session, and then Asian session is the time that we are sleeping. So, and we don't really trade the Asian session that much. We don't really trade it that much. So the dollar, I believe, is in this range right now. All right, this is the range that we are in, and we just want to see price keeping this range and then going all the way up. So we might see a liquidity above here being taken out, and then price going up. So just look out for that on that dollar movement. That is the best short-term analysis that I can give you, because it's a weekend. I cannot talk about long-term, because Trump Trump's presidency is the craziest presidency ever, and um, I cannot give long-term analysis, because once I analyze long-term, then Trump makes a decision. He just decided now that they are no more bombing Iran, and um, he can say that, oh, we are not going to do this, and then out of the blue he just does something crazy, and the market reacts to it, you know, and those are the things like that are crazy. So immediately when he, said that stuff, stuff happened. So um yeah, so that's the presidency of Trump that we are dealing with. Let me see the fundamentals that we have for next week, Monday. So obviously last week, the fundamentals that came out were um, unemployment rate for US, non-farm, so change. So the unemployment rate of the United States was dropped Friday, and no, not Friday. Wait, not Friday. Sorry, my bad. My calendar was a bit lost. So this Friday, it was the Bank of England that was speaking, right, at 12 p.m. But there was no news, later in the day that was high impact news. So there was no high impact news. And if we see this right here, this is 4 or 5 o'clock that we see price basically spiking like that. That means it's not even fundamental news. This is Trump news. All right. So that is Trump news. All right. So you see again. So do you know why the market reacted? Donald Trump has match has made his match in Jerome Powell. He said that he's appointing um, a new governor, right? So now that is going to be obviously good news, and for him to end the Gaza conflict, that is also good news. So that good news has affected the market, all right? That's why you see DXY shooting up because of the positive news, all right? He also announced on Twitter, on X, he said that he's not going to retaliate against Iran. So that itself would give people confidence in the US dollar, because they are not going at war with any country. But obviously he might not do that. He might just stall the whole thing, and then just for his troops to get closer, and then he will just do something crazy. So now you see the market is unpredictable sometimes, and you mixing fundamentals with technicals is going to help you to to be able to understand what is going on in the real world, because we are in chaotic times. Okay. We are in chaotic times, we are in crazy times, we are living in crazy times, where things are a bit unpredictable in the market, um, and that is how it is, guys. That is just how it is. Yeah. So basically, guys, so with DXY, I expect these highs to be taken out, those highs, yeah, to be taken out there, and then we might see other movements on the higher time frame, that will take place. But with the momentum, we have seen it taking out this high right here, break of this high over here, price retrace, went up, retraced, and then eventually made this break of structure, and then retraced back at this area. So we might see DXY taking out these highs right here. um but the other thing is, like, Trump is president, so yeah. But but if we are strategic, okay, with strategic ways of trading, and understanding, that Trump's presidency is not guaranteed with anything. Then you have to make sure that your risk is balanced so that you don't get emotional about everything. Yeah, so that you don't get emotional about stuff. So obviously, if we're looking for bullish dollar, all right, then we know that euro is going to be bearish, obviously, like indicated so already there. So we understand that it's a bearish market. Now you see, I explained to you already that there's a difference. I already explained to you there's a difference between the market movement and the market direction. All right, so market direction is what I told you now. All right, so when I said that DXY is having a direction of, you know, buys, it doesn't mean that it will buy immediately. The movement can be in a retracing way. All right, it might be retracing, you know, by Monday, Tuesday, and then Wednesday, Thursday, Friday it starts being bullish. And now Monday, Tuesday, Wednesday you already blew your account, and then Wednesday, Thursday, Friday, that's the time you start trading. That's why it's very important to grade your setups: A setup, B setup, C setup, and you know your risk according to the grade of the setup. All right, so Euro USD obviously sell, AUD USD obviously sell. We've seen this high being taken out, but I have my but. All right, so we see basically this high being taken out. So we might see it retracing and all that stuff, but I'm not sure, because you know why? AUD USD and these highs are not taken out, you know, actually these lows. So I want to see these lows being taken out because obviously shows good structure. I want to see change of character, so that I can, you know, start going, you know, to that direction. So I need to see like change of character below here so that I can start seeing price dropping all the way down, right? And then maybe going up again. But AUD USD cannot be too much, you know, compared to, you know, what we're looking for in the market long term. And also obviously if we're seeing that, then we might see this price going all the way up. Now the problem that I have here is that these are highs that have been formulated, right? Market created this high over here. Let me just, this high, all right, and then this high, and this low is not taken out. So price has respected this area right here, and the price actually respected again here, and now we are here, right? So that's why I'm skeptical. That's why you see I don't want to analyze the market long term on certain pairs, because they are not in alignment with DXY. All right, they are not in alignment with DXY, and they show they print a different story. But you see, I can still go with the trend. Why? Because the trend is still impulsive, retrace, impulsive, retrace, impulsive, retrace, impulsive, and now it's still at retracement. So this is now the range that we are in. So as long as I'm in this range right here, it is good. We can still look for those upward movements and follow until we see, you know, price creating that type of movement where it takes out the lows, and then we know there's a change of character in order to sell. All right, so those are the few pairs I can share with you. Obviously I will share more detailed quality setups with the student groups, basically tomorrow. Yeah, tomorrow I will, because there's still some pairs I need to vet out, and I need to get my top 10 list for my swing trading, and obviously for my day trading also I have to prepare. So I have my swing trading setups that I trade every single week, whereby I analyze the market long term, and basically I just day trade it on my small account. So I day trade the swing trades, and that helps me a lot. So I hope this video was very, and this stream was very useful for you. All right, so I'm just going to recap everything that I've spoken to you, all right, so that you can get everything. Okay, first thing first that I said was that you need to read the market before you take the trade. So don't trade the market if you did not plan it. Don't just go into the market and then you trade a setup without taking time to understand why the market is doing what it's doing. So it's very important that you understand what the market is saying. All right, top-down analysis from the higher time frame to the lower time frame, knowing that this is the the weekly, daily, 4-hour, or the 4-hour, daily, and then actually the 4-hour, the 50-minute, and the 1-minute. Whatever method that you're using to trade, there should be a way of how you are looking for to enter into the market, and there should be confluences that you have, when you are entering into the market. You cannot just enter into the market and then analyze after you have opened the trades. The second thing that I spoke about is market structure. All right, non-negotiable. We cannot negotiate that. You need to know the market structure. Where is the market going long term? You need to understand higher highs, higher lows, ranges versus trends. What break of structure means versus the noise, because sometimes it cannot be a break of structure, it's just noise. Sometimes it's the market is just creating noise. Okay, let me show you an example. If you can look at this same chart here, you see the market is showing you over here that it is selling, right? You see it's selling, and then price goes up, right? What would be the use? So someone that is on the other side of the thing, will be like, okay, this is my demand zone and I'm going to buy here. So you buy here, and then the market goes your direction, makes as if it's going to break this high and then eventually falls, because the original direction was a downtrend, but then you did not separate the noise from the original move. You did not identify that the market is just breaking this low and is creating a change of character. So obviously after change of character it fell down, and then in the process of falling it created liquidity, and in the process of creating liquidity it has to go and take that liquidity in order for the market to fall and create those perfect setups that we see right there. So those are the things that you need to understand: highs, lows, ranges versus the trend, and also understanding the difference between when the market really breaks structure and when it's just making noise. All right, so price action matters also. Impulsive versus corrective moves, you should understand. Strong versus weak closes, what is rejection, what the market means by rejecting, and also all the other important things in the market. If you don't understand those things, obviously you're going to be loser. You just lose all the time, and that's not what we want. We should be able to be traders that can identify quality setups in the market. All right, and then patience. All right, I spoke to you about patience. Why not trading is still trading. Okay, that's what I told you. The cost of forcing trades and also waiting for price to come to you the level where you wanted it to be. And personally, like you just have to place alerts. All right, so example, if you look at my chart over here, you can just see that maybe I want price to come up to here for me to buy. All right, so I just right click on my trading view and I add alert. Then you would see basically price creates for me an alert, and when price would come to that on my device, then I'll be getting a notification that it has crossed whatsoever area. So you'll be getting notification on your device regarding that specific entry or that area that you were looking for price to give you. So as you can see there's an alert there under here, right there. So whenever price touches that area, then you would see that price is now ready to go to that direction, right? So last but not least, it's very important that you understand your risk management. All right, risk management. How much are you risking in a trade? Do you know which ones are A setups, your B setups, your C setups? All right, because so many people are focusing on surviving instead of trading, and that's where some of you, I want to trade, I want to make money. Nope, you should focus on survival. Survival means this is a A setup, this is a B setup, this is a C setup. I should honor that, and I should trade according to the setup that is presented to me. All right, very important that you understand those simple stuff. Those are very simple stuff. All right, And before I go, um, I want to add a few things. You should protect your capital during uncertainty. All right, when you're not sure of the setup, if you're not sure of the setup, obviously C setup, B setup type of scenarios, that's when you actually discipline yourself by risking low, because it's a C setup, so you are risking low, and you're protecting your capital from burning out. All right, so your discipline keeps you in the long game. Your discipline will help you, you know. Imagine if the day you find your A setups and you start risking your 1%, right, not which is now quality setups, then you start seeing your market is starting to pay you off. You know, you start making 5,000 per day, you start making 10,000 per day, you start making 20,000 per day. Those are not the quality days that you find in the market. So your psychology is clean because you're using all of the mechanics together. You're not using only one thing alone. You're not using all of the mechanics and the rules as one thing. And that makes you a more profitable trader in the market. Okay, so what does that mean? It means precision over frequency. All right, quality over quantity. All right, so two good trades can beat 10 emotional trades. Two good trades can beat 10 emotional trades. You can cover quality setups and trade only quality setups and cover 10 useless emotional, you know, trades. So entry, precision versus wide stops. You know, many people want to enter trades and they want to have the best stop loss. You know, if you look, you would want to enter the market and then you want the best, you know, tightest stop loss ever. So let's say that this is the demand that we're looking at. So you'd be entering the market for your buys over there, and then you want the tightest stop loss, and then basically the market, you know, gets closer and then goes all the way up, instead of you just being conservative and then putting a little bit of pip behind so that you can still manage the trade. And then you see, whenever you see how price is going into profit, it's almost close to the TP. This is where you're supposed to take partials out. You know, all of those basic understanding concepts, understanding the concepts, understanding, you know, all of those things, adding them together will help you become a better and a profitable trader. All right, so stop loss is very important. It's not a, it doesn't mean that you're fearful. It means that you're disciplined. And this is the most important one, letting your trades work out instead of micromanaging them. The reason why you open the trade is because you analyzed it. Why are you not leaving it? Leave the trade and manage the trade. All right, don't micromanage. Oh, is it going to go up? Oh, and then because of, you know, micro candle movements, one candle, the next candle, you already start fearing. When you see a lot of profit, you want to close out. When you see small profit, you want to close out. You enter the trade, you put the stop loss, you let the trade run. So your management is now to see how far did this trade go. Is it in profit? Okay, where do I start moving my stop loss to break even? All right, the trade is deep into profit. Where do I take out my partials? All right, where, like, those are the things that make you a quality type of trader. All right, it's not about one trade, it's about your performance over time. And when you check your performance, you'll be proud of yourself because you are more disciplined, you are more, you know, more of like a professional trader. One trade will not determine your career. One setup will not determine, one drawdown will not determine your career. You don't need to have perfect entries, but you need to have a profitable track record, that even if we see that at the end of the month you've made 20%, 30%, 50% on your best months, on your weakest months, at least you have 5% profit, 10% profit. So on a 200k account, right, if you have a prop firm that you're signed up on a 200k prop firm, you making 10% is like making $20,000. That's $20,000 every single month, while you're losing in the market, because you know how to approach the market and how to trade the market. Even if you are losing in that market, you will still be $20,000 in profit. This is not a guarantee. This is rules and systems that are applied that help you to remain profitable. Systematic ways of how to approach the market. Not trading by luck, not trading and then, like this Instagram people, showing that they're making money every day. No, you can have a desire of like trading one day a million or millions of dollars in your trading account, but you should also understand that there is the foundational phase where you are growing and you're becoming a better trader, and building a professional career to know that one day, as your profits are more than your other income streams, then you can depend on your trading. So while having a job, you're still managing and learning how to trade. That is the more approachable way of how you can take trading. All right. And that's what many people don't want to trade. And that's what actually how many people don't want to trade, and that's what many mentors don't want to teach in the industry, and that is collapsing and destroying the forex industry. And I'm not about that. I'm not about that lie of people thinking that they can become rich within a short period of time. I believe in wealth that is created over time. And yeah, that's just my philosophy. I know I'm very young, but I have an old man's mind. I believe that you can make a lot of money in a long period of time, in a span of 3 to 4 5 years. But you can create wealth by making money and then sustaining it and making it multiply over time. And trading is one of those ways on how you can become that type of a trader. And many mentors, many people on social media lie to people like that. Oh, you cannot make money. Yeah, obviously. It depends on what you're doing, because there is, everyone was watching YouTube videos until TikTok came. When TikTok came, people started, brain rotting. They started trading. Actually, they started watching short form videos, and now people cannot watch long form content anymore, because of the dopamine attack, the dopamine hit. And it's also the same with traders. Traders don't want to see success. They don't want to be disciplined. They want quick success. And in the process, they're destroying their mind, because the excitement that comes with flipping accounts, if you have $1,000 account and you want to make 40,000, that's going to make you risk the whole 1,000. And there's a high chance that you're going to lose it. And there's a high chance that you're going to make 40. Just like a 50% that you might make 40,000 or you might lose it. But when you have a mindset of trading long term, then there's no way you can lose your capital unless you're very careless. All right. So with that being said, guys, hope this video was very helpful. I will try to make this type of content on a normal basis. And also, I want you to share the video always. And I hope this was informative for you. Have a blessed day.